Good morning, ladies and gentlemen, and welcome to another Boutiques on Wednesdays. I'm Pierre de Klerk from Apex Investment Consulting, standing in for your regular host, Eugene Brock, who will be back next time. Today we're joined by Helen Masson from Thyme Wealth, and we are also joined by Sydney McKinnon from Cadiz Asset Management. Good morning, Helen, and good morning, Sydney. Thank you for joining us, and thank you very much for your time. Just very briefly to the audience, maybe a reminder of Apex Investment Consulting that I represent. We are a sister company to BCI and Fundrock. We were previously called Boutique Investment Partners, but we renamed to Apex Investment Consulting in 2023. And we provide consulting services and assistance to FSPs and primarily financial advisors who would like assistance with the management of their multi-managed portfolios. And that includes macro inputs and strategic and tactical asset allocation, portfolio construction, manager selection, risk management, and the like. So if you have any interest in DFM services or interest in what Apex Investment Consulting do, you're welcome to contact Eugene or myself. Even if you just want to see what kind of research we do, you're very welcome to do that. So we'll immediately start with Helen. We're going to discuss fixed income in both the presentations, and Helen is going to touch on diversification and talk about the theoretical aspects of that, and then also the practical application thereof at Thyme Wealth. Looking forward to your presentation, Helen. Thank you very much.
Thanks, Pierre, and good morning to the audience as well. Thank you to BCI also for this opportunity. If I can ask you to go immediately to slide 2, and then I want to put this question to the audience. We know that most probably the most successful investor ever in history is Warren Buffett, and we also know his stance on diversification, and so how dare I differ from his interpretation and application of diversification. And so I have my tasks set out for me today, because I'm going to tell you why we at Thyme believe we're not applying the Warren Buffett strategy. So if I go to what Warren Buffett said about diversification, he said it's a protection against ignorance, and it makes little sense if you know what you're doing. So let's take an example. We buy American Airlines, and it's a wonderful long-term investment opportunity. We hit COVID, and then effectively for 2 years, and if you retire in that period, you're dead in the water. So we believe that compounding is, yes, the eighth wonder of the world, but we don't live in a world where time doesn't have a meaning, and so time is coming up for people at different times, and so diversification to us is the ninth wonder. I can go to the next slide.
Sorry, Helen, I just want to say that we can't see you at the screen at the moment. I know you're using two screens, so I'm not sure whether your intention is that we should see you or not. Okay, there you're back.
Okay, yeah, no, okay. Thanks for that. So if we look at you know, the definition, what do we define as diversification? Very easy. Your exposure to any individual investment is basically limited. And typically where we use it in the bond side is where you build a credit portfolio and you would limit your exposure to different credits. So it's a very well used methodology in the bond side, that you don't have all your eggs in one basket, because it does reduce uncertainty and risk, and so that the investor's capital is basically protected by diversification, better protected. We can go to the next slide, please. So why do we need diversification? I touched on it earlier in the presentation, and it's because time horizons for investment strategies requires diversification. Very important to understand that. And so timelines depend on the client requirements. But remember, for us as asset managers, it also depends on peer comparisons, because we know that we're highly compared or the competition is great in South Africa, and peer comparisons has got a time rhythm of its own. And so diversification for those two reasons linked to timing is very important for the client, but also then for the asset manager. Next slide. So yeah, okay. Yeah, I'm going to use another example. Why not diversification? And this is the last time I will say that. And this is also a quote that in market stress, diversification saves nobody, because if the market dives, we know that the correlations increase, and even if you diversify, everything falls. So I do agree with this quoting, and I just thought, let me say to you, it doesn't save you at all times, but in 2007 and 8 with the great financial crisis, nothing saved you, not even diversification. So I've got to put that in as my last disclaimer then. In terms of 5, and then I'll now focus purely on diversification in theory and in practice to convince you of the advantages. So if we look at the next slide, on slide 6. And I thought, yeah, I'll use a quote from PPS, because I think they put it in words that I don't have I can't improve on the way that they say it. They say in nature, resilience does not come from uniformity, it comes from diversity, adaptation, and balance. And they put that in the investment world. So portfolio construction in a non-normal world, because we know we're not in 1956 of the Markowitz theories that markets discount all known factors, and it's very easy then to determine the best investment. But today, it requires a different mindset and not just only a strategist. So I thought that was very well put in terms of why we actually need diversification. We go to the next slide. Okay. So let's use a practical example in 2025, because things are changing. We were just before we started discussing how fast the world is changing. And so if you look in the first quarter after Trump's election, of course, we hit tariff uncertainty. And of course, the uncertainty index, if you can see there on the right-hand side of the graph, just goes through the roof. And everybody's talking inflation and policies rates staying much higher for much longer. And so in that environment, and we compare to the next slide, the current environment, where we're talking about rate cuts, and will it today be 25 or 50, and some people even say more. On the next slide, please. Thank you. Of course, we now face a different world, because on the 1st of April, Trump changed and said, I'll give 3 months extension. And so the uncertainty went through the roof in the second quarter. People are now concerned about growth, lower rates, and a completely different to the world that we've seen on the 1st of January this year, or in January this year. And so suddenly, if uncertainty goes through the roof, then of course, growth concerns start. And this is clearly demonstrated there in the pink area on the graph, where you can see that growth from 2009 to 24 was actually only 1%, just over 1% per annum. So really dismal growth due to uncertainty. We look at the next slide, slide 9. So what happens in terms of this world of uncertainty? We of course know that gold loves it, and no wonder in the first half of this year, gold gave us a return of 20%. And if you look at yesterday, we breached 3,700, and it doesn't look like that's the end. You can clearly see how gold has benefited. And of course, that's very good for South Africa in terms of our precious metals. From 2 points of view. The first is that our rand is a commodity-based currency, and so we hugely benefit through that. But of course, we know there's a negative correlation between commodities and dollar that typically holds, and no wonder the dollar is also down then 10%. So we benefit, the rand benefits from both. And so if you look on the next slide, you can see that earlier on this year, then we could already see, and this is just the Nedbank confirmation that recently came out, that, you know, we are targeting the 17 and even talking about reaching the 17 level against the dollar. Now, that's very critical in terms of diversification and where you invest from both asset allocation, as well as selection, right through to a selection in terms of how you invest it. So to us, we've been having a rand model, and that in the beginning of the year with gold going up, already predicted on our model 1720, and gold has been up since then. So we wouldn't be surprised if we do reach a 16 big figure in terms of the rand. And that's, of course, very good for bonds, because we also know that bonds and the rand, they also tied at the hip. So let's then look in terms of the portfolio and how you implement diversification then. So the reason for that is very clear to us. But how do we implement that in practice? Of course, if you've got such strong trends that we've seen in the first and second quarter, we changed our strategy in this period from originally moving into higher interest rates for longer into the floaters. And there, I'll show you on another slide, we've increased that to basically our biggest holding. And if you, yeah, there you can see on the next slide, floaters on that pink graph showing our exposure then to floaters. If we can just go back one slide. And you can see there in terms of the return in the blue that floaters did give you in the first quarter the best return. So that the blue line is floaters, the green line is fixed bonds, and it was absolutely the right place to be, also because of the uncertainty in the GNU that we experienced locally. So from a local and a global perspective, that was the place to be. But if you look in the second quarter, it completely flipped, and their bonds outperformed because we had a completely different scenario. So the fact that you diversify does allow you then to get protection, but also then to add alpha through the markets that aren't very well discounted, and where effectively we have a non-normal world with huge politically and macro factors. We can go to the next slide, please. And so what we did not only increase floating rate note, but because of the high uncertainty and risks, we increased it in AAA paper, which was the government's floating rate note, the 2030. And because it was a new issuance at that time, we also got a kicker in terms of a spread of 145 basis points, which is collapsed right back to the 100 basis points. So we also, not only did we get protection, but we also got our performance from the spread narrowing while being in the safest asset class or rating in terms of a AAA. Next slide, please. So if you look at the second quarter, we just discussed how fixed income was the place to be, but it was not only being in bonds, it was also where you positioned in terms of the yield curve. And there you can see that the longer end was actually pricing for all fall down with more than 2 standard deviations from the historical norm. And so we did position for a bull flattening strategy, and we added more on the longer side on the government 2044 bonds, which was trading at a 2 standard deviation from the mean. So not only did the asset class matter, but also the selection in both instances, which further underpins the need for diversification at all levels. Next slide. Next slide, please. So how does it look in practice? Yes, we can see there, I've just marked there that effectively we see that clients require typically a protection against inflation. So yeah, we've still used the 4.5% mid, but you can see there we're penciling in the 3%. But even at a 4.5%, and for living you need the 3 to 5% real and a 1% for costs, you're targeting 8.5 to 10.5 return. And if you can lock in a return of 10.5%, you're absolutely meeting your investors' requirements. So why take on additional risks? So that's underlying what we look for in this fund is meeting the client's requirements. And so if you look at the performance relative to the benchmark at the end of the 2 quarters since inception, which is now 7 years, you can clearly see how we've outperformed the benchmark consistently with an alpha of over 3%. Next slide. And if you look at peer group, remember one of the reasons why we look at diversification is because we want to build a good business, and peer group comparisons are very important underpin in that. You can clearly see over 7 years, the fund is now 7 years old, relative to the peer group in July, which is the end of July, in the Morningstar report came out first. But what is interesting, if you look at all the periods, year to date, 1 year, 2 year, 3, 4, 5, up to 7 years, what we really would like, or we're very proud of, is the fact that consistently we stay top quartile, if not top decile. In this case, we were lucky we were top decile over all periods. We don't promise that we target top quartile, but it just shows you through diversification, yes, even in terms of a peer group, you can improve performance. Next slide, please. So are we trying to sell performance? Of course not. We're happy if that comes from our strategy, and we're not going to change our strategy just to say we first. But what we are is a team that loves what we do. And yes, we stand united for excellence. And we just want to do what's right. And if we achieve top tier investment results and a better future for all, that is really why we get up in the morning. So we say that what we offer is local knowledge with a global perspective. Next slide. So if you look at what is the Thyme Wealth Income Fund, it's an income fund, low risk. There you can see on the left-hand side, we all know where it's positioned. We target 3% real returns, and we're glad to report that if you look on the right-hand side bottom, the green line is actually trailing higher than the yellow line, which is inflation plus 5. So the markets that give us the opportunity to add a real return of 5, which is of course very good for the investors, And yes, we believe you have to manage the risk, and hence why we say the ninth wonder in the world is diversification. Thank you.
Thank you very much, Helen. Interesting presentation, and congratulations on your funds returns. I think it's in a space where alpha is not as big as what one is used to in the equity market. Your returns are actually remarkable, and I think most remarkable. So the information ratio, which you didn't mention per se, but it was above 1. And I just want to remind the audience that last week I explained that the information ratio above half is actually good. So anything well above half, and certainly above 1, is indicative that the good returns were achieved with very low volatility or very low risk. So well done on that. There is some questions that's come in, but we'll keep them for the end of the discussion in the interest of time. Then we'll come back and ask you some questions, Helen. So in the interest of time, we'll move straight to Sydney. If you can flight your slide, Sydney, and over to you.
Okay, fantastic. Well, thanks, Pierre and BCI for giving us this opportunity to present to you. And I thought today, it's always good to talk about our funds, which I will do at the end. But I think it's important, as Helen has mentioned as well, to have a philosophy and a process in place. I'll share with you our thinking in terms of our philosophy and process. And then, of course, there are quite a few factors that are driving interest rates in our markets at the moment. I'll discuss a few of those, and then I will also look at how that is implemented within our funds and portfolios that we do manage. But I think the first thing is, as a operation, we do not operate as a machine. It's effectively people. And that's the importance. So without dwelling on the slide, I think just to mention Cadiz is Cadiz is an asset manager, a full-on asset manager. We focus on fixed income. That is our speciality. And as you can see from the board or on the screen, there's many years. We've got a couple of gray hairs, a few of us. So we've been through a few of the cycles to see these things happen. So the people in our organization is quite important. And the way we've constituted the team in terms of their knowledge and skill and experience is actually shining through very well for the asset manager. I'd like to start off maybe a little differently from Helen. I'd want to start off with our philosophy. And I think philosophy should be quite simple. And our philosophy is quite a simple philosophy. It's saying that we provide incremental outperformance over time within defined risk parameters. And I think this is quite important because we're not a house that's going to be trying to shoot the lights out. What we want to do, and it's probably something that Helen mentioned as well, is make use of that compounding effect that one gets by being just a little bit outperforming on a small basis over time, and that compounds and that starts spiraling in an upward direction. You actually make things very, very meaningful in terms of the returns that you get over time. Obviously, risk is very important because you cannot manage a money market fund with cryptocurrencies in it, for example. And similarly, if you're managing a bond fund, being too conservative might actually let you down as well. So I think it's important to consider the risks within your ambit as a fixed income manager, and those are quite important. And that embodies our very, very simple philosophy, but I think it's backed by a very solid process. But before I get to a process, I thought I'd just quote Lewis Carroll, and we may remember who Lewis Carroll is. He's the guy who wrote Through the Looking Glass, or Alice in Wonderland, as we more commonly know it. And he said, if you don't know where you want to go, then it doesn't matter which path you take. And I think this is quite important. If we don't know where you want to be, and Helen quite nicely indicated what their targets are. I think if you don't know where you want to be with your investment, any road will take you there. So it's important to have a focus. It's important to have a target. It's important to know where you are going with, whether you're managing fixed income, equities, properties, or whatever the case may be. I think your process should actually back that up. So just in terms of our process itself, I think as far as the fixed income environment is concerned, it's very much determining the directional movement of interest rates. Which way are interest rates going to be going, so that you can position yourself accordingly to take advantage of those movement in interest rates. For us in the fixed income environment, when interest rates are coming down, it's quite nice for our bonds. We can actually get capital gain out of it. But of course, for the money market instruments, you're getting less of a return, and you have to be more competitive, and you have to be more innovative in the way that you actually construct your portfolios. But nevertheless, having a focus of looking at the directional movement of interest rates, we employ a technique which we call top-down. I know top-down is a little cliche, but it's important that you interrogate your economic fundamentals, such as your growth, your currency, your inflation. I think it's very important that you interrogate monetary conditions as well. In other words, we know tomorrow the Reserve Bank will be announcing the interest rate decision, and we put ourselves in the shoes of that Reserve Bank and try and figure out what the decision is going to be doing, what the decision they will be making, so that we can align ourselves with that. I think it's important that you do your homework as far as valuations are concerned, whether you think that certain instruments or sectors are undervalued or overvalued, and you can take advantage. I think there's even a small place for technical analysis as well, because there are players in this market that are playing the momentum game, and that gives you an indication. It's not the be all and end all of our strategy, but we do make a small some small room for that within our process as well. And then, of course, the international environment is quite important. We've seen all the different uncertainties across the globe, and I might speak about one or two of them. The important thing that I'm trying to say here is that there is no one factor that influences the directional movement of interest rates. There's a myriad of factors. And we tend to get sidetracked by hot buttons at times. Oh, it's the US or what the Fed is going to be doing. Oh, it's inflation at this point in time. Oh, it's growth. Oh, it's uncertainties as far as tariffs is concerned. And we tend to align ourselves with one or two major events. Yes, those are important, but generally those are short term. And the markets, I found in my humble experience, is quite resilient, and it actually works and looks through those cycles. So therefore, we have a bottom-up process as well, because, you know, if you have a top-down process, we can switch on in the morning and switch off at night and play golf for the rest of the day. But I think it's important that even though I don't play golf, but it's important that you actually manage your process, you manage your portfolios, and that you have to decide at some stage what security you're going to buy, what bond you're going to buy, valued at what level, how are you going to manage your duration and your sensitivity within your portfolio, what risks are playing out in the scenarios that surround these particular rates, if the rand should go one way or the other, for example. And then, you know, as bond managers, we all love a yield curve, and no presentation is complete without showing a yield curve. And, you know, but I think the yield curve tells you so much about the expectation that is out there in terms of rates, as well as inflation or expected inflation. And then, of course, the credit environment that we live in at the moment, even though we've seen spreads narrow and that environment become quite tight, is quite important in our lives as well, in terms of the portfolios that we manage. Now, I think the important thing is here, you know, it's all good and well to do all these things, to look at all the factors, to look at the monetary conditions, the economic fundamentals, do all your analysis. But you need to be able to make this real. You need to establish a level of conviction. In other words, how do I actually make this real within my portfolio? So it's good to say, right, we're long duration, but how long are you? How much risk are you actually going to be taking? How sensitive are you going to be making your portfolios? And I think that's the important part of the process that we employ, is we actually establish a level of conviction on a very regular basis. Just before I get to that and translate that into our portfolios, a few of the pertinent issues that are driving rates at the moment is a few global factors. And I want to chat through a few local factors, because I think that's important as well. And the first one on the board is global growth, because we've seen that growth, even though it's been resilient, maybe in inverted commas, we've got lots of policy changes on the cards at the moment, and that's going to present a lot of challenges. We know this is not a presentation about US tariff policy changes, but that has created a lot of uncertainty and has at times actually stifled the growth or the significance of growth in the global environment. And then there's been quite a fall off in consumer confidence in the US as well. What does this mean? Theoretically, lower growth is actually a indicator of lower yields as well. And I think that's part of the reasons why we've seen, even though in the past we've seen US Treasuries, for example, their yields blow out or continue on a negative trend, we've now sort of seen a bit of leveling off. And I think this is part of the reason because of the challenges that there is in the growth environment. Obviously, the inflation environment is quite topical as well in determining the directional movement of interest rates. And we've had these pressures starting to creep in certain economies, even though we've been in a lower inflation environment, and certain aggregate inflation has expectations have moved higher. We've seen that through goods price inflation that's been rising. And of course, everybody is waiting now with bated breath as to how the inflationary effect of the tariffs will feed through to the markets and in the fixed income markets in particular, I think, and to inflation in particular. So I think we still need to see a few prints before we can make a call on that, or a definitive call on that, because it takes time for these issues to work through the market. Of course, very importantly, it's quite important to consider growth and inflation, but the central bankers have a very challenging task at the moment to apply monetary policy. We've got the Fed that meets today or completes their meetings today, and it's widespread speculation that there'll be a potential rate cut. But I think it's become very challenging for those central bankers to remain vigilant under the underlying inflationary pressures that are there, and whether the policy rate decisions that's flying around as far as tariffs is concerned is going to have an influence on their decision. Nevertheless, I do think that there is room for the US to cut the rates, especially with the labor market statistics we've seen recently. Just bringing it home, and I'd like to look at the same three factors in the local environment. We know for a fact we've got a low growth environment, which should keep a lid on our yields as well. And I think the growth environment that we've been experiencing effectively has been as a result of low business confidence, low consumer confidence, high unemployment. And even the SARB has lowered their growth forecasts under a 3% inflation regime. And I'll speak about inflation in a second. And then, of course, we've got all the global tensions as well. So the lower growth environment is kind of keeping a lid on our interest rates at this point in time. As far as local inflation is concerned, I think at the risk of going through all of these things, and anecdotally, and I put a little note at the top where, and this I took straight off the SARB's website, where it says the family braai has become more expensive, while prices for several breakfast items have eased. Now, anecdotally, it does feel that the consumer is in a pinch at the moment, but we are coming off a very low base as far as inflation is concerned at this point in time. So you probably will see year-on-year numbers. That's the mathematics. We'll see inflation ride. And the food price inflation, which affects a large part of our populace, is also quite sticky. But because we are in this lower inflation environment, we've got the SARB targeting intentionally or less formally maybe, or not as formally, but targeting a lower inflation regime, it could very well keep a lid on yields as well. And then the last thing I want to mention as far as factors that are driving the interest rate environment is obviously our local monetary policy. And we've got the SARB meeting tomorrow, or they're meeting today and tomorrow, and will they be cutting rates? Is inflation and the new target that they've set implying lower yields? And even though we know for a fact mathematically inflation will rise on a year-on-year basis because of the low base, But I think it's quite a challenge at the moment, and the potential for a rate cut is there, but I think the SARB is going to be very astute in the way it views the global environment. So I think the important thing, what I'm trying to illustrate here, is that there are lots of factors influencing our interest rate environment at the moment. There's not just one factor. There'll be one driving or major factor maybe at one point in time, but you have to take all of these factors into account. And we do that through our process, and we derive through a systematic approach, a proprietary approach, we derive a level of conviction. And most certainly, I can tell you, even though we've come through there, you can see sort of the post-COVID period where we've been fairly negative about the markets. And then since last year, we started picking up in terms of the positivity that we've seen in the market. And we've actually benefited from being longer. And the graph that is on screen at the moment, if the red line or the red bar is above the neutral 0%, then that does mean that we are bullish or longer, and the longer the bar, the more bullish we are. And below the line means that we are less bullish or bearish on the market. Most certainly, by looking at all those factors, we are in a position to say that we do have a longer stance in terms of the way we've positioned our portfolios in terms of its sensitivity. Now, to wrap things up, because I know I'm rabbiting on a little bit, forgive me, Pierre, but I do think it's very important, even if you've got a level of conviction, you've done all your homework in terms of understanding the factors that drive interest rates, you've done your homework in terms of establishing a level of conviction, like we are a little bit long at this point in time. Your portfolios are dictated and governed by things called a benchmark and a mandate, and these differ. They're not all the same. So when we construct our portfolios, we have to look at what the mandate is saying in terms of the universe that we can invest in, the target, the goal that you're trying to achieve with that mandate, and then what are you being measured against? And you know, I always say that a benchmark has got two main functions. The first one being it's a yardstick against which you can measure yourself, an appropriate benchmark. And then it also helps you define the universe that you are involved in. And that is what we do when we do construct our portfolios. For today's purposes, I'm going to focus on two of our funds very briefly. Our money market fund, which is on the low end of the spectrum, and our bond fund, which is on the high end of the risk spectrum. I'll leave out for now, and we'll just look very briefly at our enhanced income fund and our absolute yield fund, which falls in the multi-asset space. So once again, as Helen has mentioned earlier on, we've got diversification within our enhanced income fund. It's a Regulation 28 compliant fund. It's a fund of reasonable size. It's about 2.6 billion in size at the moment. We use credit quite significantly within these funds. We've diversified over 200 counters across 40 issuers, and it's what we term designed for all market conditions. This fund is designed to beat its benchmark, which is Steffi Core plus 1% on a constant basis all the time. We know that's what we're targeting in terms of our philosophy and process I mentioned earlier. That is what we're going for. This is a battleship. It's an icebreaker. It's designed to achieve that. And most certainly, when I show the performance numbers in this table we've got here, we're very proud that this fund in its history, which is now about 14 years old, has been benchmark beating as well as peer group beating. It's not designed to shoot the lights out. We do realize that we are in an asset category that is very diverse, that multi-asset income category, but we're there to deliver to our clients what we promised them in terms of managing expectation. And I've said this over and over again, what the label says on the can is what you will find in the can. So you can be very rest assured when investing in our enhanced income fund. Our absolute yield fund employs a little bit more risk, is more assertive in terms of the risk. It has a more aggressive benchmark, reasonable size as well, close to 2 billion. And it uses the bond market a bit more actively than the floating rate markets in terms of our bond and asset allocation exposure. So you'll have diversification across the asset classes, which includes inflation-linked bonds, money market instruments, bonds, and floating rate notes to achieve its end. And similarly, when you look at the performance, you'll find that it is benchmark beating and also peer group beating, also in terms of its mandate and in terms of its goal. Pierre, I've said a hell of a lot now, so I'm going to stop there and say thank you, Nza Kenza, for my colleague who helped me put this presentation together in Tsonga, and thank you for your time.
Thank you, Sydney. Thanks for your presentation. We have a few listener or viewer questions that's come in that we can maybe tackle in the remaining few minutes we have, and then if we don't get to all of them, we'll circulate them and we'll get the answers back to the members of the audience. The first question, Helen, comes to you, and the question is, how is your portfolio currently positioned for a hold decision by the SAMPC? Will it be to the benefit of your portfolio if they decide to keep rates on hold, or will it be less than positive for your portfolio? So you muted, Helen.
Sorry. Yeah, no, currently we will definitely benefit. We still have a large exposure to floating rate notes. So yes, we will benefit if rates stay on hold. And I see something like 12 out of the 18 economists do predict today that it will be on hold. Yes.
Do you feel you're well positioned for a hold decision?
Yes, we are.
Okay. Sydney, there's a question to you, and the question is, what do you think the likelihood is that there might be sanctions from the US against certain ANC senior officials, and maybe if they're not appeased, even a restriction on US companies or funds or entities to invest in SA sovereign bonds? Is that something that could plausibly happen and affect our market?
Yeah, Pierre, I'm not a political analyst, but I think anything is possible. And with the Trump's administration, it's not impossible that things like this could happen. Yeah, I would hate to see sanctions, but I think markets have been resilient through time. I think it's going to be a bit extreme if we do see sanctions. But at the end of the day, if I'm sitting in London and I need to make a call on how I'm positioning my portfolio in terms of my emerging market exposure, my developed market exposure, then the global funds are not always just run out of the US. The global funds will actually go for where they see the best bang for their buck in terms of the risk associated with it. So I don't think it will be a major. We're not we're small in the bigger scheme of things, which could mean we're a bit more sensitive. I don't think it will have a major impact on us. If it comes to that, I don't think we'll get sanctioned. I really don't. I think it's a lot of noise at this point in time. But if there is, and if I'm sitting in London and I'm managing a global portfolio, I'm looking at investment principle and investment fundamentals. I'm looking at how is my exposure, what is my exposure to emerging market, and I don't think that it will have a major impact on our market, because we still offer very good real yields to the rest of the world out there, extremely good real yields, and that's why maybe I'm leaning to potentially a rate cut as of tomorrow, because the differential between our repo rate and our neutral rate is quite wide. So there's almost a inherent pull to actually bring the rates down at this point in time.
Thanks, Sydney. And staying with the US, a question that I mentioned to you before we started the presentation, and that is that there's a lot of talk currently around the US bond yield and US bonds being kind of, historically been the perfect risk-free asset. But the correlation between that and other asset classes are changing in the current macro environment, and that's why gold's doing well. And we saw all these kind of strange correlation behaviors. And the question is, is there a version of the future in which the correlation between other sovereign bonds kind of decouple a bit from the US bond yield? And I suppose the real question then is there a scenario where SA bonds can still do well even if the US bond yield goes up to reflect concerns about US debt levels and so forth?
Yeah, no, absolutely, Pierre. If you look at US bond yields over the last maybe year or two, or even going back 5 years, yields have actually risen. And I was asked the question earlier this week: are we seeing a turning point for yields? So it's almost the opposite of what you're asking in terms of whether US Treasuries remain the benchmark for risk-free rates. Look, the world can always change. I just think that the US market is just too big at this stage of the game for a differentiating bond, whether that's out of the Europe or out of the East, or Japan or China, whatever the case may be, to have that formidable force. And we've seen this time and again, whenever there's a crisis, the flight is to the US bonds, regardless, to US Treasuries. So that dictates more than anything else where the treasuries will reside. So no, I don't think that it's going to be a major factor right now. In terms of our market, we've seen periods, and this is just because of my grays, I've seen periods that we've correlated so well with the US market, and then there's times where we've just decoupled for various and different reasons. I think at the moment what's driving our yields lower is lower inflation expectations, the fact that we've got low growth, those in the economic fundamentals, the fact that there's going to be less supply in our bond market, and that is overshadowing what is happening in the US market. Yes, as Alan mentioned in her presentation, in times of crisis, all boats rise with the tide or go down with the tide, whatever the correct saying is, and we'll experience that together with the US. But for now, I think that there are more local factors driving our market than US factors, should it come to that.
Thanks. Thank you for that. And then another question on your products themselves, or your kind of your offering, and I can put it to either of the managers. I'll put it to you, Helen, first. And the question is, given that the fixed income or this flexible multi-asset income space is quite competitive and crowded in a sense in the SA market, what would you say is your edge or your competitive advantage? So why should investors consider your fund compared to other funds?
I've got to agree with Sydney. I didn't put a lot of emphasis on it this morning, but your underlying investment philosophy and process, I think that is critical for any investor. You have to stick to it. It's not always working in your favor. That's why I say we don't want to market performance per se, but you've got to understand where it comes from, what you do, and what you're good at. And communicate that clearly, which I think Sydney did very well in his presentation.
So clearly clarity of process, and in your case, I would say very solid risk management seems to be part of that process if one reflects on your information ratio.
If you look at this product, we believe that is critical. People don't want to lose money in the income fund. So yes, to us, risk management in this portfolio is the number one decision-making criteria. So we, for instance, if you look at our portfolio, our credit rating is AAA. We limit credit to maximum 25% because it's illiquid. If things goes wrong, you can't get out. So it's just part of our processes that we don't like credit. We like liquid instruments where in a world that changes a lot, that you do allow, or possible that you could, without huge losses, change your strategy, because the world is very complex. It's not the way that it used to be. It's definitely fast moving, move on information, like Sydney said, momentum. And the change is fast, yeah.
Thank you. And Sydney, from your side, why
Yeah.
Cadiz in this space?
Why Cadiz? Yeah, similar answer, and I think my colleagues are gonna rag me for saying this because I've been beating this drum for forever and a day and a year, is that I say we don't manage money. We manage two things. We manage expectation and we manage risk. And I think that's what sets us apart. If it's no use me giving you something you don't want. If we can agree and manage what you want, and if 1% above inflation or 2% above inflation or 5 or whatever, as Alan said, if that's what you want and we can agree that's what you want, then we design our product for that. So that's the one thing. And the second thing that we manage is risk. So money is incidental. If we give you what you want in terms of your expectation, and we manage that within the defined risk parameters, then I think we go a long way in terms of keeping our clients happy and keeping our clients consoled and confident in being able to invest with us.
Thank you. I'm going to conclude it there. There is some questions that we didn't get to, but we will circulate it to both of you, and then you can maybe supply answers that we can forward to the audience members that posted them. So thanks again, Helen and Sydney, for your time and your interesting presentations this morning, and congratulations on your returns, and especially your risk-adjusted returns. And what you do for investors, and thank you for your association with BCI. We do appreciate it. To the audience, thank you for attending and for the questions asked. We'll get the answers that we didn't get to you. And please join us next week again for another Boutiques on Wednesdays. We will have Investec, Investment Management, and Aluwani Capital Partners that will be presenting. So please join us again. Thank you, Helen. Thank you, Sydney. Thank you, audience. Enjoy your day.